In the middle of the night, while the world was fast asleep, the entire global financial system was just seconds away from total collapse. There were no breaking news headlines, no panicked citizens, no politicians scrambling to give speeches. There was only a handful of central bankers, sweating bullets, talking frantically over phone lines, and moving billions of dollars across international borders. They were quietly, almost invisibly, saving the world from a financial apocalypse. Now, you've probably heard of the 2008 bailout. You've definitely heard of the Great Depression. But this was the single greatest financial rescue you've never heard of, and it changed everything about our modern world. Not with a loud bang, but with a barely audible whisper. To really get what happened in this invisible rescue, we need to rewind the clock to September 1998. It was a time of what seemed like peace and prosperity. The Cold War was finally over, the internet was just starting to boom, and Wall Street looked absolutely unstoppable. But hiding behind all that optimism, a quiet mathematical monster was growing. It was a hedge fund called Long-Term Capital Management, or LTCM for short. LTCM wasn't just any old hedge fund. It was run by the absolute best of the best. We're talking PhDs from MIT and Harvard, and even 2 Nobel Prize winners in economics. These guys truly believed they had cracked the code of financial risk itself. Their supercomputers could model the markets down to the last decimal point. They called their strategy arbitrage. Wall Street just called it genius. At its peak, LTCM controlled over $120 billion in assets, all of it built on borrowed money. Leverage was their superpower. For every single dollar of their own money, they borrowed 25 more. And as long as the market stayed calm and predictable, their profits multiplied into the stratosphere. But here's the thing about markets. They never stay calm forever. The fuse that would blow everything up was lit thousands of miles away from New York, in Moscow. In August of 1998, Russia defaulted on its government bonds, sending massive shockwaves through global markets. All of a sudden, LTCM's carefully balanced trades, these tiny bets on price differences between similar assets, completely stopped working. The price spreads widened instead of closing, their computer models broke, and their positions turned toxic almost overnight. Within just a few weeks, the fund had lost billions. Its losses were so enormous that no one even knew how deep the rot went. Major global banks, Goldman Sachs, Merrill Lynch, Credit Suisse, UBS, they all had trades tangled up with LTCM. If the fund went under, it would trigger a catastrophic chain reaction through the entire global financial system. The world was standing at the edge of a cliff, and almost nobody knew it. That's when the Federal Reserve stepped in. But not with your taxpayer money. There were no public bailouts or big press conferences. This rescue happened entirely behind closed doors, coordinated by the most powerful institution you've never voted for, the New York Fed. On September 23, 1998, the biggest players on Wall Street were summoned to a meeting at 33 Liberty Street. Inside, Fed officials made the situation crystal clear. LTCM had to be saved. Not for its own sake, but for everyone's. After 2 incredibly tense days of negotiation, 14 of the world's biggest banks agreed to inject $3.6 billion into the failing hedge fund in exchange for taking control of its assets. No taxpayer money was used, no laws were changed, but the entire global financial system had just been rescued by a private agreement brokered by the central bank. This was the very first time in modern history that a private company's failure was treated as a threat to the entire system. It was the moment that moral hazard became a global principle. When the dust finally settled, the rescue had worked. Markets stabilized, the panic subsided, and within a few months, LTCM was quietly dismantled. To the general public, it was barely even a news story. But to the insiders, it was a terrifying revelation. If a single hedge fund could bring the whole system to its knees, what would happen if one of the giant banks themselves started to fall? That question haunted the financial world for the next decade, and when 2008 came, it was answered. In many ways, the LTCM crisis was a full dress rehearsal for the great financial crisis 10 years later. It was the same pattern: massive leverage, overconfidence, mind-boggling complexity, and the risk of contagion. But there was one crucial difference. In 1998, the Fed could just call a few CEOs into a room and solve the problem. By 2008, the system had grown too big, too interconnected, and too fast. The moral hazard that began with LTCM had metastasized. Every major bank secretly believed it would be saved, and they acted accordingly. So when Lehman Brothers fell, the same domino effect that the Fed once feared became a brutal reality. Markets froze solid. Credit vanished. This time, there was no quiet, neat rescue. There was only chaos. The lesson of 1998 had been completely misunderstood. Saving one collapse had only postponed a much, much bigger one. But the story of the greatest rescue you've never heard of doesn't stop there. Because what the Federal Reserve did next was far more ambitious and far more secretive. In the early 2000s, after the LTCM scare, the Fed began building a network of international liquidity lines. These were mechanisms designed to pump US dollars anywhere in the world at a moment's notice. These swap lines connected the Fed to central banks in Europe, Japan, and beyond. When 2008 hit, these swap lines became the invisible arteries that kept global finance alive. Trillions of dollars flowed through them, unseen by the public, unvoted on by any government, and completely unstoppable. A system originally built to handle LTCM's collapse had quietly become the backbone of the entire global economic order. And today, it's still there. Modern markets are faster, larger, and far more complex than anything anyone imagined back in 1998. But the logic of that night at the New York Fed still governs everything. When something too big to fail begins to fall, the rescue must be instant and often invisible. We've seen it happen again and again. In 2020, when COVID froze global markets, the Fed injected liquidity at record speed. In 2023, when Silicon Valley Bank imploded, authorities guaranteed all deposits within days. In 2024, when emerging markets wobbled under dollar pressure, those same swap lines open once more. Each time, the system survives, but each time, the precedent gets deeper. The world no longer waits for crises to happen. It preemptively bails itself out. So, was the LTCM rescue a success, or was it the beginning of a dangerous addiction? On paper, it was a triumph, a private, efficient solution that saved the global economy. But beneath the surface, it completely rewrote the psychology of risk. Investors learned that the Fed would always step in. Banks learned that being massive was the ultimate protection. And markets learned that even catastrophic failure could be negotiated away. It was the quiet birth of moral hazard, disguised as financial prudence. The phrase, too big to fail, hadn't even been invented yet, but its soul was born that week in 1998. And yet, without that rescue, the modern world as we know it might not exist at all. Without the LTCM bailout, global credit might have collapsed entirely. Emerging markets could have gone dark. The dot-com boom, and maybe even the internet age itself, might have never happened. The rescue created time for innovation, time for globalization, time for the next era of finance to unfold. But it also created a deep dependency on central banks, on easy liquidity, on perpetual intervention. It gave us both stability and fragility in the very same breath. If you want to see the legacy of that forgotten night, don't look at old Wall Street boardrooms. Look at the global financial system today. It's a network so tightly interlinked that a tiny interest rate change in Washington can shake housing markets in Mumbai or London within minutes. The machinery of rescue, born in 1998, now hums constantly beneath the surface of every market. You can't see it, but it's always there, automatic, reactive, and unrelenting. And the question is no longer whether central banks can save us. It's whether they still know how to stop. History will remember 2008 as the Great Crisis. But the real turning point, the moment when rescue became a reflex, happened a decade earlier. A hedge fund collapsed, a phone rang in the middle of the night, and a few people in a single room changed the fate of global capitalism forever. They prevented a catastrophe, but in doing so, they also wrote the unwritten rule of our time. The system must survive, no matter the cost. That's the story of the greatest financial rescue you've never heard of. And perhaps the most important question it leaves us with is this. If every failure is always rescued, what happens when the rescuer itself fails? Thanks so much for watching. If you found this story as fascinating as I did, please hit that like button and subscribe for more deep dives into the hidden forces that shape our world. See you in the next video.